Hi there, folks. Sean Broderick. I'm here at the New Orleans Investment Conference, and I'm talking to Scott Melbye. Now, he and I have talked on and off for years, mainly about uranium, because he is the Executive Vice President of Uranium Energy Corp, but he also has like a bird's eye view of what's going on in the uranium market itself, what's really driving the metal. And so what this video is about is those forces that are at work in the uranium market. Scott, could you please speak to that? What do you see as the major forces really pushing things along now?
Well, it's very encouraging, Sean, and thanks. It's always great to visit with you and your viewers. We are now seeing some exciting developments in the uranium market. Through this venue, we have talked about the tightening fundamentals that have been kind of developing for some time now. It's really been, a peak of global production in 2016, and we've seen consistent production cutbacks over the past 2 years. Mm-hmm. We've seen demand clots way back from the post-Fukushima impacts to now a point where we're back at above the point that we were prior to Fukushima. So all that's great and that's fine, but it hadn't really had the impact on the uranium price until now. And I know we've all, we know that the low in the uranium market was in November of 2016. We hit $17.75 per pound in the spot market. Today, we're trading close to $29 a pound, so we've seen a greater than 60% increase over that time, but we've seen a couple false dawns. Yeah. We saw the price kind of on good news out of Kazakhstan. We saw the price tick up to $26.50, or production cuts from Cameco. It's happened twice, and then it's settled back down to the $20 level. So what's great this time is we're seeing this sustained increase have some legs under it, and as we move through $30 a pound, I think it's safe to say that this recovery is truly underway, and that it's happening on just very strong basic fundamentals, production cuts, strong demand. You also have an added kicker of investment funds coming into the market and buying uranium and taking it off the market. That it's not allowing that uranium to hit the spot market, so it's all good.
Okay, I'm just going to mention a few more specific things. You can tell me if they're completely full of crap, which if they are, that's good to know. But if they're true, then we'll just elaborate that a bit. One is Cameco. Since you bring that up, they actually shut in production at like one of their big mines, but they still have long-term contracts to fulfill. They just announced earnings, and they beat earning expectations basically because they closed that mine because it's cheaper for them to buy on the spot market. So they still have 1 to 3 million pounds to buy this year, and there isn't much left in this year. And then they have 10 to 12 million pounds to buy in like 2019. So they had a mine they shut in. So that supply is gone, and at the same time, they're coming to the spot market. And I think that has to have, multiple impacts. It has a big psychological impact. It crystallizes to like what people can see. Boy, this is really happening here. And yeah, there is that actual physical demand. They're clawing up all the stuff all the time.
Absolutely, and you nailed it in saying that it has a double impact. You have the cuts to supply, which is positive, but because they have the contracts they need to fulfill, they're in the market, and I think the original number was about 15 million pounds purchased between now and the end of next year. There was about 4 million of it to be purchased this year. They're about 2.5 million pounds into that purchasing program. And every time Cameco comes to the market, and they currently are in the market right now for 500,000 pounds, they just clear off another tranche of supply. And they come out again, they clear off another tranche. And so you see this market being walked up very gradually. And I think that's, I'm sure some investors would like to see that price going up more quickly. I actually think it's a good thing because Cameco's measured, methodical approach at covering off these uranium purchases is actually causing the market to recover in a much more sustainable way. I mean, if they wanted to, they could come tomorrow for all 15 million pounds, and we'd have $40 or $50 a pound tomorrow. But it wouldn't be a sustainable kind of recovery in the market. So yeah, it's definitely something you can watch in the market. About every couple of weeks, Cameco comes in to buy a little bit more, but they'll really step up those purchases in January and February when they have some big deliveries that they've got to cover at that time. So definitely a very positive development.
All right, great. That was more insight than I thought I would get, so thank you very much for that. Also, Kazakhstan's national uranium company is about to go public,
Right.
and so they kind of have to they have to make that company look as good as they can
Right.
going into that. But also, once they actually do bring it public in London, then they'll have to answer to shareholders, and I don't think they'll actually want to flood the market then. So, like, people can see this happening, and so they're actually preparing for that as well.
That's absolutely right. As they IPO the company and they become a publicly traded company, even a portion of the company trading publicly, they really have to start acting and thinking like a free market-driven company and not state-owned. They recognized that 2.5 years ago when I went and joined them in an advisory role, and they wanted to lift their game in terms of strategic development and marketing and sales. That was all leading up to this, and so the impact on the market, what that looks like, more production cuts and more production discipline. It means they've cut off some very damaging relationships with traders, where they were doing big offtake sales to traders instead of direct relationships with utilities. Well, that gave a systematic backstop to the short game that the traders were playing. It was a systematic short play on the uranium market, backed up by the offtakes from Kazatomprom.
Because they always had
that flow coming in, and so it made it very easy. Since that's been cut off, you've seen that short game go away, and now we're looking at it's more of a long play in the market. And then certainly this summer we saw the big impact of the strategy that after they've done all these things, they still have unsold uranium, trying to put that uranium into uranium funds, which effectively sequester uranium off the market. An example here is the Yellowcake PLC out of London. It was launched in an IPO this summer. They've bought 8.4 million pounds of uranium from Kazatomprom in the past 6 months. That's 8.4 million pounds that would have been in the spot market. So you begin to see the impact of both Cameco and Kazatomprom, the world's two largest producers, are effectively aligned in their interest for higher prices. And you're right, a successful IPO for Kazatomprom needs a healthy and strengthening underlying commodity price, and they have the ability and the power to impact that.
Well, I'm so glad you brought up the uranium funds, because that's part of my presentation tomorrow. We used to only have one, which is the Uranium Participation Corporation.
Right.
Then we got Yellowcake in July, and there's two more planned.
Right.
One in Australia, one
Correct.
in New York. This may not be the end of it, but even if that's just it, all those funds need to stock up with uranium because that's their business. And so people can see that happening as well. They can see that in the spot market.
Yeah, and folks that remember the last big bull market where we went from under $10 a pound to all the way up to $137 a pound. A feature of that bull market were the physical commodity fund investments. It was the emergence of UPC, other hedge funds jumping in and buying uranium. So that kind of activity serves as a real accelerant on the market. So we're seeing the supply and demand fundamentals tighten, because of production and because of demand. But when you layer on folks like Yellowcake, UPC, the new one, Uranium Trading Corp, and Tribeca out of Australia, you now see unexpected demand on the market. So it's demand that doesn't show up in any reactor uranium requirements forecast. It kind of comes out of the blue, and it has the added impact too. It is like a utility buying and burning the uranium in a reactor, in that this material is all sequestered off the market. So it has the same impact as a production cut in that regard. So it's a phenomenon that we saw in the last bull market, and we're definitely seeing it, perhaps, in a bigger scale this go around.
Okay. Well, the last thing that I want to bring up is, because we're having a discussion about this, long-term contracts. And like I was asking you, have there been any long-term contracts actually signed recently? Because it just seems like people are actually purchasing in the spot market and not doing the long-term contracts.
Right, and that's, this is kind of the next shoe to drop. I mean, we've seen the production cuts, the demand recovering, but the utility procurement cycle, that's when utilities come to the market to sign long-term contracts again. And it's kind of interesting because they've just as the producers are rolling out of their hedge contracts, while the other side of that contract is a utility that's suddenly finding themselves more uncovered. They're not jumping back into an 8 or 10 year long-term contract with a producer. They're tending to say, uranium prices are in the 20s. I'm going to buy off the spot market, take a very short-term view on the market. Well, that's good for them in the short term. It averages their average uranium procurement cost, but it's not very strategic in trying to head off what's coming. But we know that as we go into the 2020 timeframe, the uncovered requirements jump up dramatically for utilities. What happened last time, and history will repeat itself, is they were very complacent about the market until it started to take off, and then they all panicked and they all rushed to the market and contracted at the same time, and we saw that being a contributing factor to the $137 uranium price.
Right, the huge surge.
So yeah, I mean, in this uranium price recovery, we are truly in the first inning, and we still have one of the biggest impacts yet to hit, which will be that utility contracting. It'll be interesting too, because they are going to come to the market then and say to the producers, I'm ready to contract and sign long-term contracts. Well, now suddenly the producer's going to look at it and go, I'm not sure I want a long-term contract. I would rather ride the market up with the recovery, and that's how these markets interact, and that's how you get prices going up quite dramatically in a short period of time. So stay tuned for that. I think 2019 is going to be a very exciting year for uranium investors. I mean, we've been talking about the inevitability of this happening for some time, but now it's kind of turning to an imminent. Stay tuned. It's going to be a good year to come.
That's about all my questions. Thanks very much for answering them all. I appreciate it. Is there anything else you'd like to add before we go?
No. Again, it just again for long-time investors in the space, I think your patience is finally going to be rewarded. I think we're getting a lot of new interest coming into the space too, in both the retail and institutional investors rediscovering uranium. So again, it's not too late to be establishing those positions, but I think once it starts to take off, it's going to be an interesting ride.
Get ready for the atomic rocket. All right. Thanks very much, folks, for tuning in. Thank you very much for speaking to my subscribers. This is Sean Broderick from the New Orleans Investment Conference. Another great interview. This one just taught me so much. I hope you learned something too. Thanks.
Thank you.